Why do interest rates rise and fall? A straightforward, down-to-earth explanation. Interest rates might sound like something that only bankers and economists care about, but they actually affect almost every part of your daily life. Everything from your credit card bill to your mortgage payment, car loan, job opportunities, and business investments are affected by interest rates. To put it simply, an interest rate is basically the price of money. When money is cheap, people borrow more. When money is expensive, borrowing slows down and the economy cools. That's the basic idea. Let's break this down using some everyday examples. When interest rates are low, borrowing becomes cheaper. People find it easier to take out a mortgage. Car loans mean smaller monthly payments. It seems like credit card interest is a bit easier to handle these days. Businesses borrow more to grow, open new branches, hire staff, and take risks. Cities feel more lively, more restaurants open, more shops launch, more help wanted signs appear. Can you think of a time when your city felt busy and full of energy? There are new cafes opening all the time, construction sites everywhere, people spending more freely. There's usually a low interest rate environment behind that scene. Now, let's imagine the opposite, rising interest rates. Then, out of the blue, the monthly mortgage payment goes up. Car loans become unaffordable. It's a fact that credit card debt grows faster. Small businesses aren't borrowing as much money. Companies are putting their expansion plans on hold or even freezing hiring altogether. People are buying less, especially things they don't really need. You start noticing little signs. The restaurant that was always full is now empty. The shopping mall feels quieter. Your friend says their companies put hiring on hold for now. People become cautious. This is how it feels day to day with higher interest rates. The economy slows down on purpose. So, the big question is, why would a central bank want to slow the economy? The main reason is pretty straightforward: keeping inflation under control. When prices start going up too fast and money loses value, the central bank gets involved. Raising interest rates puts the brakes on spending and borrowing, which puts pressure on prices and slows them down. It's like turning down the heat on a stove that's boiling over. But when the economy's in a bit of a slump, loads of people out of work, shops empty, businesses cutting back, the central bank lowers interest rates. Cheaper borrowing means more spending, more investment, more hiring, and a boost in economic activity. To help you picture this, think about temperature. If the economy gets too hot, interest rates act as the cooling system. If it gets too cold, interest rates can act as a heater. There are three main things that decide whether interest rates go up or down. Inflation trends. If inflation is rising too fast, interest rates will almost certainly go up. If inflation is falling, there's room to bring rates down. Economic growth. If the economy is strong, companies are hiring, and demand is high, interest rates may rise to stop the economy overheating. If growth slows down and spending weakens, interest rates might be lowered to support activity. Here's the lowdown on the global situation. Strong global currencies, rising international interest rates, or global financial stress often push countries to raise their rates. When global risks fall, central banks can be more flexible about cutting rates. Here's a simple neighborhood analogy. If everyone in the neighborhood wants to buy cakes from the same bakery at the same time, the bakery can raise its prices because demand is too high. That's inflation. The central bank puts up interest rates to make people spend less, which puts the brakes on price pressure. It's like when you try to get more customers in the bakery. If the bakery's empty, business is slow, and nobody's buying anything, the bakery keeps prices the same or lowers them to attract customers. It's like a slow economy, and the central bank lowers interest rates to encourage people to borrow and spend again. So interest rates aren't just random. They're carefully adjusted to keep the whole economy balanced. Higher rates can make things a bit slower. Lower rates speed things up. And you feel these changes directly. Your mortgage payment might change, credit becomes easier or harder, job opportunities might expand or shrink, and businesses either grow or pause their plans. To put it simply, interest rates are the beating heart of the economy. When it beats faster, the economy heats up. When it slows down, the economy cools down too. But the goal is always the same: keeping the system stable and healthy.